everyone. Welcome to you, our clients, our prospective clients, business partners, and friends. My name is Jill Larkin, and I'll be your host for this event. Today, we present a panel discussion about our investment markets, what's driving them, our reaction to these movements, be those reactive or proactive. We'll include our insights into some of these very important topics, such as the conflict in the Middle East, perhaps inflation, and of course, the upcoming election, amongst other things. Please make sure to watch to the end of this video, because we'll be closing our discussion with our recommendations about what you should be doing in response to these market movements. Allow me to introduce our esteemed panelists today. They are Mr. Clive Eggers, Head of Multi-Management, and Mr. Manti Seligman, Head of Asset Management. Welcome, gents. It's such a pleasure to host such an accomplished panel.
Thanks, Jill.
With such a broad range of topics, it's really hard to know where to start. Perhaps we can kick off by providing a broad overview of what is driving the markets at the moment.
There's obviously always a lot going on in the news and a lot that's impacting markets at any one given point in time. I think we just like to draw out 3 or 4 key themes that we see as being the biggest influences on markets at the moment. And it's important to understand that behind these news stories, there's always an element of reality and its real impact, and then there's more the perception around that. So you'll hear us refer to whether the market has taken account of a news story or not, whether it's reflected in the market prices, in our opinion. So the first really big theme at the moment is inflation. It is something that we're all painfully familiar with, especially those of us living in South Africa. Inflation is something that impacts all of us, the price of goods going up. And we're relatively used to the concept in South Africa, but for many years, 2 decades, in fact, it was relatively low in the developed world. That's US, Europe, and those type of places. Now, we've all been dealing with higher inflation after COVID. One of the biggest drivers for that was the supply chain shortages, which impacted the price of commodities and other components. And the market was working towards, probably during the course of last year, the understanding that inflation would moderate and drop down to pre-COVID levels. And that would free up the central banks of the world, including the Federal Reserve from the United States and our own South African Reserve Bank, to cut interest rates because they no longer had to worry about staving off higher inflation. And unfortunately, what's played out is that the inflation has moderated, it has come down, but it's still not at the levels that it needs to be to give comfort, in particular to the central bank that matters the most in the world, the Federal Reserve, the United States Central Bank. And essentially, the problem is there's a strong difference in the growth of the economies around the world. In particular, America is still growing very, very strongly. We saw that off the back of their very loose monetary policy, which effectively put a whole lot of extra cash in the system, both into consumers' hands and made business conditions more favorable. And that has persisted despite the fact that they're sitting with historically high interest rates now, which normally slow down economic activity sooner than we've seen at the moment. So there's the sense that the market is waiting for that reality to come in, waiting for this interest rate impact to have an effect and for inflation to come off. And really the rest of the globe, with a few exceptions, are struggling economically, don't really have the same capacity to handle the interest rates at these levels, but are ultimately forced, because of the way that economies and financial markets work, to largely keep their interest rates in step with the United States. And the classic case in point is our own country. We have relatively high interest rates, and we don't have any growth in our economy, and we've got ridiculously high unemployment. So we need an easier monetary environment, lower interest rates to stimulate our economy. The problem we've got is our Reserve Bank has to focus on keeping inflation in control. Their concern is if they cut interest rates too soon, that would lead to a weakening of the rand versus key exchange rate crosses like the dollar, like the euro, that would ultimately inadvertently lead to inflation as prices of imports went up. So they are being forced basically to keep interest rates at a relatively high level, despite the fact that although our inflation is higher than the midpoint, it's within the understood target of 4 to 6%. So as this inflation story plays out, we see that impacting markets quite dramatically. We saw a very strong rally in November, December last year, and we saw all of that given up and more in the first quarter of this year as the expectation that it was going to slow down faded. To the point now where it's still a relatively low probability, but some are even saying that there still might be one more interest rate hike in our future, which we all are really hoping won't be the case, particularly those of us with home loans and other debt. Yeah, the other key component going on in the globe is obviously around elections.
I think elections is obviously key to our own market. I mean, there are a number of elections, in fact, going on in the world at the moment, with the US coming up later in the year. But I think more topical at the moment would obviously be the South African election process and the elections coming up shortly, sort of 5 odd weeks away. I don't believe that South Africa's ever seen an election like the one we're going into now, with the number of political parties contesting that we currently have. You have a number of pollsters that have put out radically different polls where it varies anywhere from the high 30s to the low 50s in terms of the ANC retaining its majority or not retaining its majority. But I think if one focuses on the actual economics of the election, so let's put aside the results for the moment, I think that from a risk perspective, the South African market seems to have discounted at this stage to a large extent all of the risks of a negative election. So I think the broad expectation is that the ANC could dip below the 50 and would have to enter into negotiations with other parties in order to maintain their dominance. But I think that if one looks at the impact that that would have on our market, it is by a large measure, I think, taken into account already in terms of the pricing that we're seeing relative to where we were at the end of last year, and just in terms of the global valuations that we're seeing. So, we're not that negative in that I don't believe that at this stage we're looking at any catastrophe. We don't believe there's going to be any real change to economic policy in terms of an outcome of the election at this stage that should impact the markets. And we're fairly comfortable that we are on top of the markets in terms of our asset allocation and where we are. Clearly, we're going to monitor that and we will adjust as we go along. But at this stage, we're seeing, I think, the South African market being relatively cheap in terms of valuations compared to the rest of the world. I think just one other note here, and it's not really election driven, but more interest rate driven, that Clive was alluding to earlier. And that is, the US right now has got a huge debt burden, and that debt burden is growing. With interest rates where they currently are, the ability to service that debt is becoming more and more difficult as well, meaning that they have to keep issuing additional debt. And a lot of that debt is being invested in on a global basis. So you're seeing people still using the dollar as the bellwether currency, and the returns on the fixed income market are fairly strong, which is also putting a lid, I think, at the moment on the equity sort of pricing that one is getting. Obviously, a lot also depends on where the earnings season, which we're currently in, comes out in terms of the big AI stocks and the Magnificent Seven, or what people call the Magnificent Seven, some of which seem to be losing some of their shine. But that remains to be seen.
Yeah, I think Matthew makes a great point there, particularly on the impact of the interest rate environment and how it's basically meant that investors internationally haven't had to take on very much risk to earn a decent dollar return. So because interest rates in the United States are so high, 5% plus, you can pretty much sit in one of the lowest risk assets on the planet, US government bonds, and earn a decent return. So that means that emerging markets assets are out of favor, and that actually adds to the reason why South African assets are so cheap. So South African asset valuations are cheap, both on the equity space and the bond space. And that further substantiates why, although we understand the uncertainty around the elections, we don't pretend to have a crystal ball around it, the markets are pricing in a lot of the potential negativity of an outcome in the election. So as Matty says, we do monitor that, but we think that's less of a concern than some people would argue. The third point that we really wanted to touch on is if there wasn't enough to give investors concern at the moment, or at least to cause divergence in the markets, because markets really don't like uncertainty, is we've got two global conflicts, and one of them's been with us for a while. It's Russia's attempt to take over Ukraine, and then the third, which is arguably related, is the conflict in the Middle East, and obviously there's a lot going on there. Emotions run very high. I don't think it sort of really does us any value to try and dive into that and work through it step by step in terms of who's done what to date. Suffice to say that conflict has the potential to unsettle markets further. So, for example, Iran's attack on Israel, we definitely saw a spike in risk off the following Monday. It has settled somewhat, but that just means that investors get a little bit spooked. You do see oil price, for example, because the oil comes out of the Middle East, still predominantly rise on the back of that, and obviously that can add to inflation concerns. So we sit in a world in which valuations in certain parts of the market are extremely attractive, both in South African assets, non-US assets predominantly, and China even, for example. However, that's contrasted with some serious unknowns around global inflation, global conflicts, and then on top of that, really high real interest rates in some fairly defensive assets. With this underlying concern that Manti spoke to, where the US debt is growing, and what the market's really grappling with is the US is ultimately the lender of last resort in the financial system in which we now operate. So the markets don't really know what to do with a US that is potentially losing its creditworthiness, or maybe not totally, but certainly is less creditworthy than it was when it didn't have as much debt. So that environment creates a fair bit of uncertainty. And as Manti says, it's something that we do monitor and we position for in terms of our portfolios.
Thank you for your valuable insights. I know that I've learned a thing or two about how the world is reacting to global issues, as well as how our local events impact our investments. But what is GTC doing in anticipation of these events, or in reaction thereto, the unforeseen ones at least? Let me just be more precise in my question. How are we positioning our portfolios in this volatile environment?
Great, Jill. So I can kick off there. I think a very good idea just to take a step back and remember how we manage our clients' money within our house view portfolios. So our house view portfolios target real inflation targets over long-term periods generally, and they do so without taking on excessive risk. In other words, we're trying to achieve that investment target without taking on any more risk than we need to within the portfolios. And we build our portfolios diversified across different asset classes. So that means we have shares, bonds, cash, local, international, etc. And then we make use of different investment strategies within those asset classes. And we have a long-term holding to those asset classes and managers, which is called a strategic allocation. And then based on what we see unfolding in the markets, we make tactical changes to that, short-term changes based on valuation. So in other words, we don't want to be in assets that are very expensive, because those traditionally have a higher risk of losing clients' money. And we like to be invested in assets that are decent quality, but offering good longer term value. So the challenge we've had in this environment is the expensive investments have got more expensive. So Manti's referred to them already, the Magnificent Seven, great story. We understand AI is impacting the world. It's got a good long-term future, but the market generally tends to get carried away with itself and effectively overbuys certain assets and drives up the price of them. So we've tended to we have exposure, but we haven't been overweight those areas, and we've favored the valuations of those assets in the market that are offering better value. Just if I talk about the current environment, what we've done here is we've recently upweighted our offshore exposure. So South Africa is a great investment destination, despite how we sometimes feel about our home country. Particularly, we have some attractive assets listed in the equity and bond space. Despite that, we're a drop in the ocean, and there are great opportunities elsewhere in the world, and some of those are really offering great attractive evaluations. So we've increased our offshore allocation. However, we've been careful not to invest that into the expensive sectors of the market, like the US tech sector. So we've basically moved more money into developed markets that are attractively priced. That has meant that our exposure to emerging markets, which we've been overweight for some time, that's basically reduced that overweight both to emerging market assets and South African equities. We remain fully exposed to local cash. Our money market rates are attractive, and a slight overweight to South African bonds. And then in the listed property space, we're still underweight. Yes, that did mean that last year's rally we missed out on. However, if you look at the risk return profile of that space, there's still a number of unknowns in that market that gives us just a little bit of cause for concern. So we're comfortable remaining underweight. I can hand over to Manti just also to talk about how we think about potentially putting on protection at times on specific parts of the portfolio.
Thanks, Clive. Yeah, it's very important to ensure that one is well diversified. And I think the currency markets at the moment are probably more tricky than they've ever been in terms of what's presenting value. You have the rise of crypto, which I must say we do stay away from because of its volatile nature. Doesn't mean to say that it's not an asset class that one should never look at, but certainly in terms of our conservative standpoint, it's not something that we have gone into. But what it does tell you is that there are investors out there that are very nervous about what currencies they're sitting in. The Eurozone is not in great shape. The dollar has been actually very strong, despite what a lot of people have thought over the last few months. But at this stage, in terms of the amount of debt that they have to issue as well, it's not looking as strong as it was. And of course, people are very nervous of the rand based on current political and geopolitical influences that are happening here. So it's very important to be diversified and to ensure that when you do have an opportunity to lock in profit, that we do. So what do? We enter into currency exchange rate swaps, where we have the ability and the flexibility at no cost to the portfolio to be able to either cap out or to ensure that we have exposures to the currencies that we want at the stages that we want. So it just brings us flexibility in the portfolios to ensure that we have both diversification and that we try and lock in when we have had a gain in a currency, that we actually ensure that that is not lost to the portfolio going forward in the event that there is further volatility.
Hey, that sounds really good. Well done. Thank you for allaying many of our fears and confirming that you're on top of all of this, well, as much as can be expected, given the unforeseen events which often happen overnight. Ukraine and Gaza, just as an example of those. None of us would have predicted those in the 21st century. But given our insights and our preparatory positioning of our portfolios, what is your recommendation to our clients? What should they be doing in response to all of these developments, those that have happened that you've just told us about, and those that we still anticipate, elections, for example?
Bob, I think, well, let me jump in, and then you can follow, because this is always an interesting topic. But as professional money managers, it's something that we're monitoring continually, and we look at the various risks at the times at which they impact, and we make calls based on our knowledge and where we're at. So, it doesn't help to jump in and out of markets, because I think historically, if you look at what's happened, You take a long-term view for correct strategic reasons, and you tweak them or you monitor them as you go along. And that's what we do at GTC. It's a team of professionals that are continually watching. So, I would certainly say to our clients, you entrust us with your cash for good reason. We understand the markets, we look at the markets on a continual basis, and we are adjusting our exposures. So no reason to get in and out and to try and make calls yourselves. That's what we're here for. And we do have strategic asset allocations, and they are continually reviewed. And I think that we've proven over time that in the long run, to be an investor, you need to be looking at the long term, not at the short term.
Absolutely. Yeah, I fully echo what Nancy said there. I mean, it takes real discipline to remain invested. And that's also the purpose behind a communication like this, is just to remind our clients that despite all the noise and chaos in the market, the team is still managing the money through this. The portfolios are designed to deliver over the longer term. And quite clearly, we understand that there are going to be short-term storms to weather. So our client interface team that engages on a regular basis with our clients, they're the right people to talk to. But unless circumstances in your life have changed, in other words, there's been a life event like you're approaching retirement or something to that effect, there's absolutely no need to make changes. And as Manti has already said, making changes on the back of fears around markets or trying to max out an opportunity almost always leads to loss of capital. So the short answer is they can sit tight and engage with our client interface team, but there's no need to make changes at their level to the portfolio.
Gents, thank you both of you once again for participating in our discussion and for sharing all of this information with us. I'm sure that our audience is very appreciative, as am I, of the insights that we've gained, and is very assured of your continued expert management of our assets. So let me not keep you from this important work any longer. Thank you very much. Guys, please don't forget to like this video and to subscribe to get notified of any future videos which we release. Thank you very much for watching.